what is your tariff takeaway at the end of the day? When you look at the market, it seems to be screaming growth scare.
Yeah, I think that, I look at this as really an intersection of, when we came into the year, a lot of, tremendous animal spirits on taking risk on in virtually every asset class. And now we're at a collision between macro paralysis. And so when you talk to folks that are inside boardrooms about strategic M&A, about IPOs and other large cap capital formation activities, there's just really a standstill right now. And certainly in the short term, the conversation about stagflation with the tariffs and other activities and tax cuts, that's got to be a short-term conversation. But, as Ryan said, heightened volatility, access to some companies are sometimes in question. Those are periods when we as a franchise and the world of private capital, private credit, we welcome these opportunities because there's always great companies that need to get financed. But certainly you have a white-hot marketplace that has been punched in the face the last 5 to 6 days about the reality of not 1 or 2 initiatives out of the White House, but a dozen initiatives and 70 executive notes in the first 32 days. So it's an extreme time that many of, or if not all of us, have never been through before.
To that end, Schonfeld has actually held up well against its peers in this environment. It's been brutal. A lot of people, as you say, Jim, have definitely felt punched in the face by this market. What's working in this market?
Sure. So as I said before, I think some of the strategies that we deploy that tend to benefit as the ranges of individual stocks expand is what's working. So for us, we've got a big quantitative trading business. When market volatility and market volumes increase, as we sometimes see in these periods of uncertainty, that can be a really beneficial market for some of our quant trading strategies. Some of our short-term trading strategies that can take advantage of some of the momentum or the reversal of momentum in some of the stocks that ultimately probably got to valuations that were too high based off of some of the animal spirits that Jim mentioned. Leaning in and deploying more risk in those type of strategies has certainly worked, as well as some of our volatility strategies that ultimately benefit from the breakdown in the correlation regime that we've seen over the last 15 months. And so those are the things we're leaning into. Of course, some of the strategies that are short vol, that in the end of the day are more momentum oriented, that outperformed, in the post-election period up until Inauguration Day. Those are the areas and those are the parts of the portfolio that are struggling. And so trying to figure out as investors how we square some of our risk in those areas and make sure that we're set up for the uncertainty that's likely to continue going forward. I mean, if what we've seen over the last 40 days is any indication of what we're going to see over the next 4 years, we need to be prepared for consistent tweets, consistent executive action and things of that nature. And so as such, it's really important that we start to reposition some of our portfolios.